Hello, YouTubers, and today, as you see on the screen, we'll cover the weighted average cost of capital, in short, WACC. WACC is basically tells the total average cost for the company, right, to do any project or to run in the business. So basically, that's what high level WACC is. So in this video, I will show you the WACC formula, and then I'll use the spreadsheet today to cover some different scenarios to how to not only just to go on the what is WACC is, but also to let you know how can company optimize so they can have a lower WACC, right? Because if we have a lower cost, we'll have a higher profit. That's second thing. And third thing is also for sure we'll take some scenarios where if the company has some project, whether it makes good to invest in that project or not, right? So once you understand basically the key components of the WACC, what it's composed, and how then it's with things get lined very easily. So as usual, I'll go slowly layer by layers, and then go into the more details. Okay, so if you are new to my channel, I mostly do the fundamental analysis on the stocks, and my name is Pramod Kumar. I am a CFA charter holder and FRM certified. I also have my website here as mentioned. Okay, so let's get started. So on the screen you have seen this the formula for the WACC, right? So let me take my pen out, and then you can only see me whiteboarding, and then see what is this all about. Okay, so as you can see on the screen, I have this formula. So basically what this telling us, so this basically what is this piece, as you can see, and this piece, right, of the formula. Let's tackle this first. Okay, so let me first give you maybe easier if I give you what composed of WACC. So basically, in order to start in order to run the company, right, we need the capital or the money. So the capital can be arranged on broadly on from the two types, right? From the creditor, right? Creditors. Either the company can issue bonds, right, or go to the market, right, and come up with the equity, right? So in the equity. So this is fixed. You know, if there's a fixed rate over here, and then the company has to pay interest. And this is so. This is two ways, right? So for example, let's say if the company has total capital, so these both will make the capital, right? This is what the total capital in there for the company. So if let's take a hypothetical example. Let's say if the company has only $10,000, right? It's a very small company. This is $10,000, right? Out of this $10,000, let's say the $4,000 the company gets some from kind of a fixed loan, or right. So this is $4,000, right? And I'll once you understand this, then this will become very easy. Honestly, it's nothing like a rocket science here. And $6,000 it comes from equity, right? $6,000 come from equity, right? So that's how this $10,000 comes from. Okay, now therefore sure nobody will give the money free, right? So the cost to raise this money, this is RD, right? This debt, which is this one, this figure, right? And the cost to raise this R, right, which is this here, right? R, right, which is this one here, right? So this cost can be calculated using CAPM, which is the cost of equity, which I have covered in depth in some other my different video. So you can check my channel, search, you can easily find it. There are some other model like famous French model, bond yield premium model, and so on, but this is quite famous in the market and easy, so you can but just for your knowledge. Okay, so that is okay. So on the This side, right, in the fixed cost, right, so which is from the debt holders, right, so or easy ways here is the debt, right, because debt can be a different kind, right, so this is the debt and then this is the equity, right, so these are the two official names rather than just I'll say in the bond, right, so it's to for the raising of capital, right, in the balance sheet. That's how it's get divided. Okay. So there are a couple of okay, so now we have this one and this one, right, so let's assume this is 4%, right, they say, they go to any debt holder, they say, okay, I can give you the $4,000 but it will cost you 4%, right, and similarly the cost of equity, let's assume this is let's say this is 8%, right, and that we are just assuming this performer, right, but now so this is our, so we got this one and this one, right, and in if you go to the 10K and all, they have a breakdown in the cost of the debt there, so we can easily get from there, and also on the cost of the equity, as I mentioned, there is another video, you can find how to compute the cost of equity or required return on equity using the kappa model. Now coming to this piece, right, what is this? So MVD is nothing but the market value of a debt, right, so it's market value of debt. Okay, and MVCE is nothing but the market value of common equity, right, common equity or equity, right, in short, right. So basically these, what by using this, the market value will get the weights, right, how much the cost these are in short is coming is called weight. So these basically give us the weights or the percentage of how much money of, let's say for example 10,000 is coming from 4,000 and how much percent is allocated to 6,000, right. So for example in our example, the cost of the debt is, so if the market value of the debt is and we assume in our example is 4,000 and the market value of equity is 6,000, then $4,000 plus 4 plus 6, right, so which is 10,000. I just want to show you how exactly in the formula, so there is no ambiguity, right, $6,000 plus the $6,000 here, and then this is denominator is same, right, plus 6,000, right. So if I so this is, if I compute this, calculate, so this will come as 0.4, right, and plus this one is 0.6, which will equals to 1. So one thing to note here is these weight always should be 100%. We cannot have 80 or 60%, right, so this is one way to check. So this means the 40% of the capital or 4, or if you take in, this is in decimal 0.4, but if you take in percentile, it's a 40% is coming from here, from debt, right, and 60% come from the cost of equity, right. Now this piece, right, so what is this? So this is the tax rate. So one thing to note here and easily get mistaken by some newbies, right, so this is the pre-tax rate, right, so this is the pre-tax rate, marginal corporate pre-tax rate, and you can easily get in from the company's 10K. Okay, so this is the one. Okay, now I'll open the spreadsheet and use this to all the components to come up with the WACC, and then I'll also show you how we can best basically come up with the how each component, if I switch it, it will reflect our weighted average cost of the capital for that company, right. So let me open the spreadsheet. Okay, let me come back to okay, so I think is okay, so let me make it bigger. Okay, so now I think it's easier hopefully to see. So WT is just nothing but these are the weights of a debt. This is the weight of equity. So this is just these are just the input, right? This is the debt pre-tax rate is 6%, I assume, and on the cost of equity rate I assume it's 8%, and this is nothing but the sum. So as I mentioned to you, these weights of debt or weights of equity should be equal to 1. The tax rate for the company I have taken as 20% for now. The cost of the debt I have leave blank because these are the input, and now we use our formula and then calculate the cost of the debt and cost of equity, and then this is nothing but WACC is the sum of cost of debt and cost of equity. Okay, so let me go and calculate it. So here, as we know, the cost of the debt is, we take as this rate, right, times 1 minus our pre-tax rate, right? So this is the pre-tax rate, right, times the weight, which is the, if you remember, in 40% in our example, right? So this is 0.4. Okay, so this is come out as 0.92. Similarly, if I do the cost of the equity, which is this times 0.6, this come as 4.80%. And if I simply sum these up, this will give me the weighted average cost for this our hypothetical company, right? So that is this. So now let's say, so this is my cost. So one thing, so this is my cost, right? So let's say how give a little bit of a flavor what we think. Okay, what if happen, let's say if our tax rate will be lower, right? So easy answer is, okay, if the tax rate is lower, this means our net income is higher, right? That's because the company retain more money. But how it affects our cost of the debt, right? So just for the let me put it here, right? So the assumption, so I'll put it here, my tax rate, right? So just I'll copy this here, okay, sorry, there, okay, and then I copy this here as well. Okay, I copy this here just for the reason because I play with the tax rate, okay, and then I'll show you how it affects. So if my, and then I'll show you, copy the weighted average cost as well. Okay, oops, let me copy the value. Okay, so with my 20% tax rate, my cost of the debt is this, and weighted average coming to this. So let's assume suddenly we get a break, and just some hypothetical example, our tax rate comes to 5%. Can you make a guess what will happen to our weighted average cost of capital? Do you think it will go up or go down, right? If you want, you can pause this video and then for a minute, and then, but for me, I'll go ahead. Okay, so I'll change this to, let's say, to 5%, right? You noticed here, the lower the tax rate, right, it increase our cost of debt from 1.92% to 2.28%, and increase our weighted average cost of debt. Okay, so that's little bit, if we different, right, as our because the higher the tax rate, basically is because of the 1 minus in the formula, this is 1 minus in the formula, right? It cuts our the weighted average cost. So higher the tax rate, this means lower our WACC. Okay, so that's what we have learned from here. Okay, let me go back to the spreadsheet. Okay, so this one, so I'll copy this here. Okay, maybe I'll remove this here, right? So I'll put a note here. So let me put it back 20% and just change it. So the note 1, right? So let me put the note here. So it's easy for you. So you can take a screenshot and all, right? So higher the tax rate, lower the cost of debt, and in return, therefore, lower WACC. Okay. Oops. Maybe I'll merge this cell. Okay. Okay. So, okay. Now, what about the next thing? So, now the next thing is, which I want to highlight here. Do you think that this WACC is the optimal WACC based on their given percentage of the cost? Right now, our cost is 6% for the debt and 8% for the equity, right? And the company is taking 40% weight to the debt. So basically 40% capital is coming from here and 60% coming from here, right? And this is our total cost. So I'll save this here for you and show you one more example scenario, which is very key. So plugging the number is not important. Anybody you can give, even if I give to my kids who is in primary school. So basically, if I give the number, for sure, I think they, based on this arithmetics, this is nothing but minor division and addition, right? Anybody can do. I think they can do. But the gist is to go deeper into to understand what this is telling. That's important. I think that's what we need to understand here. So if I'll switch this to, let's say, to 50%, right? Let's say this is 2.5, and then this is, I need to do here 2.50% here to make this weight 100%, right? 1. So as you notice, when I change it, my cost will come even further lower, right? When my weight is 50-50, my cost reduced to little over 30 basis points, right? So 0.30%, right? So this means the company was not performing at optimal on the optimal cost basis. So let's play a little bit more. What about if I'll do more? If I'll have more 0.8 here and then 0.2 here, this means the company is even further can able to reduce the debt. So this means it's the best is interest of the company to raise more debt, right? Because the cost of the debt is lower as compared to the cost of equity, right? To have it. So that's another very, very important point I like to add here, right? That the second point is the optimal company need to consider optimal cost, optimal weight, right, in their sources of capital, right, which is nothing but debt plus equity. Okay, now Okay, so this is here. So this is pretty much here. The next point which I have seen, let's assume if there is a project, right? Now company has, so how, now the next thing is what we will do. So that is a very easy part. Let's say if the company has two projects, project 1, project 2. In the project 1, basically the return is, let's say only, let's go back to my old cost structure, right? Let's say 0.5 and 0.5 just for the fun, right? And let's say it's can only able to return 6%, but the project 2 can able to return the 8%, right? Do you think the company should do this project or not, right? Should invest in this project. Company has only 10,000, let's say $10,000, right, to invest, right? And the cost for both is $10,000, right? The cost for both is $10,000. Do you think company should invest in this one or this one? Now the easy answer is company should invest in the project 2, yes and no. Why? Because this WACC is giving us, because 6.4 is our cost is higher than our return. So this means company won't add value. So add value, let's say, let me tell you, right? So if this is 6%, right, and this is my cost, right? So this means the company will lose, if company will lose 0.40%, right? At the same time, if I'll do the for invest, if the company invest in project 2, the company will add value 1.60%, right? So if I assume this project is for 1 year and the company has invested 10,000, so let's say in the dollar terms, in dollar value, right? So then this will be simple as that. Right? So this means this one has the negative value, and which certainly we don't want it because our cost is higher, right? And this one is giving us positive value, right? Now let's go back, and if we think there are, and this is what the corporate finance department pretty much they're doing. They do, right? They take all the cash flow. This is very simple example, right, for 1 year, but I don't want, so let's assume this one is, let's say 0.2, and then this one is 0.8 with a different capital structure, right? In this one, oops, if this is the case, then still our project 2, right, our cost is 7.36%. In this one, this will be, this is even worse, right? It's 1.36% losing, and this is only adding value to 0.64%. So does it really make sense to add in a some only do a lot of work for only 0.64% adding a value? Then these kind of questions the company management think and decide, right? So this is very small hypothetical example, but hopefully it will give you the good insight onto the WACC different component. So just to highlight one more point, reiterate again. So if I go back to my where I started, so the WACC is nothing but is the weighted average cost of capital. Here we have weight. Weights are determined first by the market's value of debt over market value of debt plus equity. Second important point we have learned that this is the pre-tax rate of debt. and the cost of equity can be taken from the CAPM model, where we have another video shown, and rest is pretty much as we can see, we have shown you in this in the spreadsheet. So if you like this video, kindly subscribe and like my channel. And I do have very deep fundamental analysis on the stock analysis like Apple, Nike and all. So please go and watch and share the content to more people, so more and more people will like, and hopefully I'll reach the 1,000 subscribers soon. Okay, thank you. And if you want me to cover any other lecture on any other which you have confusion, so please comment on the video below. Thank you, and see you in next video. Bye for now.